Good morning. It's Saturday, November 5th, 2022. It's 10:14 a.m. on the East Coast. I will do another video discussing junior miners a little bit tomorrow, including Nine and West Haven, maybe Endurance as well. Just a few brief comments on some juniors. So, what happened yesterday? Why was gold up more than $50 an ounce? Why were gold miners up double digit percentages? And um, everybody wants a narrative. Obviously, we don't know all the motivating factors of all market participants in real time. Uh, but we can try to do our best. And it's pretty clear to me that after Powell was interpreted to be hawkish during his press conference that led to the market sell off on Wednesday afternoon, gold was floundering around Thursday afternoon around 1630, and it started to slowly move up in Asian trading Thursday night. I think there were a couple factors there. I think one of them is these China reopening rumors, which evidently are not true now on Saturday morning. I think that was a little part of it, but a much bigger part of what happened with precious metals and mining stocks on Friday had to do with a series of statements from Fed speakers, including Boston Fed President Susan Collins, Charles Evans, Chicago Fed President Charles Evans, and the Fed Vice Chair. And they're all sort of singing a similar tune that leads the market to price in a higher probability of 50 basis points next month. And then at the February Fed meeting, which happens on the first day of February, an even higher probability of 25 basis points instead of 50 basis points. So suddenly the market went from Wednesday afternoon seeing the Fed funds at 5% by February 1st, maybe even 5.25%. Now the market's seeing at 4.75%. And so why is that a big difference? Well, prices in markets are made on the margin, and the fact the Fed's going to be slowing down offers a greater probability that the economy will slow down in time for the Fed to pause sooner. So we're not going to use that other P word. We're just going to use the possibility of a pause in early 2023. And then a pause sets the stage for the other P word happening maybe 3, 4, 5 months down the road from when the pause starts. So all of this just brings forward a potential dovish shift in Fed monetary policy stance. And again, prices are made on the margin. And when sentiment is all bombed out and washed out, like it was Thursday, then a few factors align simultaneously and you can get a move like this. Now, maybe there's some other things coming. Definitely Treasury buyback announcements in the back of my mind. I don't think it's coming next week, but maybe in the next month or two, that could happen. And that would be generally a positive uh, catalyst for precious metals. Okay. So we don't need to try to explain the whole thing in great detail, but the jobs number Friday morning was probably not as strong as it looked on the surface. In fact, if you look at the household survey, uh, we actually lost 328,000 jobs in October. I think that, Mike Shedlock does a really good job of digging into these jobs numbers. The labor market is solid. Some might even say it's strong, especially if you want a lower income job. You can get one, 15 bucks an hour, 20 bucks an hour. If you have a few brain cells and you can use, electronics, if you can use your iPhone, you can make 20 bucks an hour, lots of different ways, right? So there's lots of those jobs available out there, but there's also a lot of signs of weakness. And look at the mining sector since 2020. We've lost jobs, mining and logging, and mining was notably weak in October. So the fall in metals prices, whether it's copper or silver, gold, nickel, this is affecting the mining sector now. We are actually seeing the mining sector stagnate. Construction, obviously, housing is getting hit hard by the increase in mortgage rates. And so these sectors are likely to continue to weaken and actually probably go negative over the coming months. So the labor market is slowing down, and that should also gradually bring down inflation. But remember, this is not going to happen overnight. This is going to be a process. And for inflation to get back down close, I'm not even going to say too close to the Fed's target range, will take a minimum of another 6 months. And it could even take up to a year. So that's why we say pause, and then the pause could happen for several months where we just stay at the same rate, and then the market speculates on when that uh, turn lower may happen later towards the end of 2023. And that's sort of what's going to, how things are going to play out next year. So this is interesting how, there's all this speculation Thursday and Friday that China's going to get rid of the zero COVID. They're going to reopen everything back up. And this Barron's post says they quash the rumors, and they're going to keep zero COVID. Um, we must give first priority to life and prevent the outbreak of the pandemic and commit ourselves to the dynamic zero COVID policy. I don't understand China at all. I'm not going to even spend any more time on it, but this looks like it's a negative for equity futures at the open Sunday night. Some articles about central bank gold buying this weekend, and central banks bought a lot of gold in Q3. Take a look at this article. Take a look at some of the different charts out there you can probably find. But it's clear that there have been some big central bank buyers of gold in the last several months. And I would not be surprised if the two primary buyers are China and Russia. Here's your Fed rate hike probability. So we're up to over a 60% probability of 50 basis points next month. And then you can see it's about 50% chance um, of a quarter basis point in February. And, we can start getting into the terminal rate conversations, but it's pretty clear we're probably going to go to 5%, maybe five and a quarter. But I am really skeptical that the Fed is going to go above five and a quarter. I think five and a quarter is the upper bound. I actually think 5% is the upper bound, but there's no point in speculating or worrying about that now. Friday's trading action in the market was really wild. We had this big run up early on off the open, then actually gave it all back, within about an hour to an hour and a half, and then caught a bit into the close. This is really a whipsaw filled session, but you know, take out all the noise and all the minute to minute variance, and it's clear to me that the market has sort of a magnet to the 3,800 level in the S&P, and that magnet is growing stronger every time that it gets much under that, down to the low 3,700s. It finds buyers, goes right back up to 3,800, and then obviously heading into the Fed announcement last week, we got up above 3,900 briefly, and that didn't last for very long. It got slammed right back down. So it seems to me that stocks, generally speaking, as measured by the S&P 500, this is in an oscillating range-bound environment. And you shouldn't read too much into any one day action. Big down day doesn't mean that it can't have a big up day the following day and vice versa. So just keep your head on a swivel and don't read too much into day to day action in this market environment. We talked about gold already. Pulling it out to the daily chart, put it into context. Yeah, it was a big move, but look at this big downtrend. Um, Zooming it out, obviously, you look to the left on the chart, there is some big support around 1600 to 1625. So far, that support is holding. We closed above 1680, actually. This chart doesn't quite show it, but we did close above 1680 at the very end of the day on Friday. And so now, the key upside levels are going to be, well, 1700, pretty big round number. And then a lot of people are talking about 1740 just because that's this high over here from early October. Um, I would not be surprised if gold gets above 1700 at some point next week, but I would also not be surprised if it doesn't hold above 1700 for very long and comes right back down to the 1675 area. I think that gold miners can rally just if gold is able to hold in the 1675 to 1700 area. They're so beaten down, and so many of them, like Equinox Gold or I Am Gold, some of these quote unquote lower quality, higher beta, mid tiers, they were thrashed so hard in the last couple of weeks. It basically out of concern that gold was going to drop under 1600, and some of these mid tiers, their all in sustaining costs are up above 1600, 1650, even 1700. And so suddenly, if gold is at 1620 or 1600, or God forbid lower, these companies are full of red ink. They're actually losing money on an operating basis. So for gold to just hold around 1700 would actually be a major positive for gold miners over the next couple of weeks. And we could see further upside in some of these charts. I mean, look at the GDX or the juniors. I mean, these are pretty well constructed bottoming patterns. You can call them a head and shoulders if you want to. It's a little bit more than a head and shoulders now because of what happened on Wednesday and Thursday. It's not a perfect head and shoulders pattern, but call it what you will. It's a potential bottoming pattern, and there's a lot of time that's been spent down here since the end of August hammering out a bottom, and now it could be time to break out of it and squeeze some shorts, have a counter trend rally in this widely hated sector. I love these patterns in these charts. And Newmont, really, it's been a terrible year for Newmont, the biggest gold miner in the world. Stock has been beaten all to hell, and it got beaten to hell Tuesday, Wednesday, Thursday of last week, and then boom, Friday up over 8%. This looks like a failed breakdown, and we know that sometimes from failed moves come fast moves the other way. So we were breaking down, everybody was capitulating in their gold miners on Thursday. Everybody dumped their Newmont at 38 or 39 on or even 37 on Thursday, and then boom, we close up around 41 on Friday. So this is a potential failed breakdown. So there's lots of really nice setups in the gold mining charts. Now let's not get too crazy here, because remember, this market has no memory from day to day. But I will just simply say the stage is set for more upside at some point next week in the gold miners. That's not to say that this sector is going to rally straight through to the end of the year, but there are a lot of factors in play here, including positive seasonality over the coming weeks for this sector. We have all these nice chart pattern bottoming setups. We have really negative sentiment. This is an under-owned sector. So put it all together in one big picture, and I believe the odds are favorable for further upside in the gold mining sector over the coming days and potentially over the coming weeks. I would prefer to buy a pullback, but sometimes these stocks will just go up, especially when so few own them and they're so widely hated. We talked about Equinox. What a whipsaw here. I generally don't really like this company right now. They're sort of in an unfavorable situation, building a massive new gold mine, having to take on more debt, and some of their assets, some of their better assets are not performing very well. But that doesn't mean that this can't, rally back to maybe 320 or 330 over the next, day or couple of or the next few days or next couple of weeks. But generally speaking, I don't have a favorable view of EQX right now. IAG, IM Gold, they're going to report earnings after the bell this Tuesday. I like this chart setup. This is another one of these lower quality, mid-tier gold miners. I feel like they're starting to turn the ship around and get their act together. Let's see what the report, looks like Tuesday after the close and what they have to say about their Cote project, a big new gold mine that they're building, and then their Nelligan asset, which is likely to have an updated resource announced as well. Let's see how big and high grade that one is. If that comes in north of 4.5 million ounces, I think that's going to be a star asset for the company over the coming decade. But let's wait for that report and then we'll dig into it a bit deeper on Wednesday. So talked about gold miners. Want to make one comment about the yield curve and bond yields. So we've had a deeply inverted yield curve now for several months. This is like 100% indicator at this point that a recession is coming in 2023. We just don't know how deep it is. Is it going to be a shallow one? A shallow one that lasts for a few months, or is it going to be a deeper one that lasts for more than a year? We just don't know, and there's too many variables, too many factors that we don't know how they're going to play out to make an accurate forecast there. But it's pretty high probability at this point that a recession is coming in 2023. And generally speaking, for gold and gold miners, that's sort of the sweet spot where you actually want to buy into the sector just when the economy is going into a recession. And usually that means their labor costs are moderating or dropping. Some of their big input costs like oil are also lower. And that's also when monetary policy often starts to ease, and that's bullish for the gold price. So we are we we don't know if we're there exactly yet, but we are getting very close to the sweet spot for this gold sector. And the hatred of it is so great right now. People are so sick of these stocks. They're so sick of gold. Everybody's so confounded. Why is gold down this year if inflation is so high? Well, let me just say this. From May of 2019 to August of 2020, so that's a 15-month period, gold went from 1275 to 2085. So it rose over $800 an ounce, over 60% over a 15-month time period. Inflation during that 15-month time period was less than 2%. So the gold to inflation correlation is a lot more complicated and not nearly as simple as people think it is or want it to be. And that's just one example. So we had a period of relatively low inflation that lasted for several years, but I'm taking a sort of a choice, uh, time period during that multi-year period where gold was low at the start of it, around 1275 in May of 2019, and it peaked August 7th, 2020 at 2089 per ounce. That was a hell of a move for gold over just 15 months, and inflation barely budged during that time frame. Now, okay, I know you're going to say, well, from early 2021 to now, inflation has gone up 15%, 20%. And what has gold done? It's down. Okay. The correlation is complicated. And people who just say gold is an inflation hedge, no, it's not. It's a monetary metal that has multitude of driving factors and variables, macroeconomic variables that affect it, including central bank buying and hedge fund trading, buying and selling. Okay. And simply put, go to a physical bullion dealer and look at some gold coins, silver bars, gold bars, and look at what the prices are there, physical. Um, the market is pretty tight for physical. And the prices are a lot higher than they are on the COMEX futures. Now, not to say there's a conspiracy or anything, but clearly the financial versions of the metals trade much differently and have way heavier, influence from hedge fund short term trading than the physical, market does. Um, and then, we basically felt like we got peak hawkishness from Powell, the press conference on Wednesday. In fact, I wrote about that Thursday morning. I felt like it was peak hawkishness from him. That doesn't mean that the Fed funds rate is not going higher. It felt like he really was putting on his best hawkish look to try to jawbone things down a little bit. But look at what happened Thursday and Friday, and look at the other Fed speakers. And Powell definitely left the door open to 50 basis points next month. Now he did say there's a ways to go, so it could be 50, 25, 25 the next three meetings. That's a ways to go. That's 4 more months and 100 more basis points, but then they're done, right? Then they could be done. And then we pause for a bit and we see how things play out in the economy, how deep the recession is, and then obviously markets are going to be focused on a downshift in rates and possibly an ending of quantitative tightening. But it's way too early to talk about any of that. But last week's Fed press conference felt like peak hawkishness from Powell, and it looks like the bond market agreed because we've made a lower high in the 10-year note yield. So clearly, there's plenty of support for the long end of the curve around a 4.2 or 4.3% yield on the 10-year. Obviously, some investors are seeing that as an attractive proposition. So that's definitely something to make note of. Chevron, so the oil sector was one of the stars of 2022. We are seeing a seismic shift in the stock market and the real economy from fake companies with no earnings and uh, faked up, business models based upon hype and hope to companies that make real stuff that drive the world, that drive and fuel the economy. And there's no better example than Chevron, literally a company that fuels the world, fuels the economy. And this going out at a 52-week high, a multi-year high. So there's a major bifurcation where you have stocks like Meta or Tesla that have broken down, making new 52-week lows, having terrible earnings. And then you have the oil sector making new 52-week highs almost daily. Freeport McMoran, so copper and gold miner, had a huge day on Friday. I wouldn't be surprised if this gives a little bit back early next week just because of that China news, sort of dashed hopes that they're ending the zero COVID. But look, this stock bottomed months ago. So while, copper has been messy, and while everybody is negative on the economy and the outlook for the economy, Freeport, one of the world's biggest copper miners, bottomed over the summer. It bottomed more than 3 months ago. Albemarle, so lithium. This is a chart that I like, and this is one that I'd much rather be long of than be short of. And it's in an uptrend above the key moving averages, the relative strength is in bullish territory. And I wouldn't be surprised if we see this one back above 300 by the end of the year. Copper, talked a little bit about Freeport. So this has been forming what is likely to be interpreted as a bearish pennant for the last several months. And then last week, looks like it's trying to break out above it. Let's see if it gets follow through this week. Really, the key upside level is 380. Although this looks like it's breaking free of the pennant, these things can break out and then come right back into the range very easily. It needs some further upside, and I would like to see a weekly close above 380 to confirm that the bottom is in for copper. But this is, again, a chart that looks like it bottomed during the summer. Final commentary, CCJ, the uranium seasonality trade for November. So Cameco, last 20 years, up 70% of the time in the month of November, and it averages a more than 10% gain in the final 2 months of the year since 2003. So that's pretty strong seasonality there for CCJ. Cameco, it's down so far in the month of November. This chart, this daily chart, is a hot mess. But I'll tell you this, I will be a buyer of further weakness, especially if we get down near that key 22 level early next week. I think this is one you just buy the ugly chart on weakness and look for a move back above 24, 24.50 over the next couple of weeks. So that's it for me this weekend. Have a great weekend, and I'll see you in the trading lab.